The only one I produced was this one over here. So,
All right.
Pretty iconic.
Oh, you guys can't see me?
Not yet.
Oh, there
There
it
you
is.
are.
Yep, there's Nate.
Okay. Paul's good. We're
Yep, I'm
good.
good. I just hung up with the plane, so I'm good.
Hey, let's hit go, Mark.
All righty. We are going. We are live.
Awesome.
Welcome, everybody. We've got 9 attendees in so far.
Yep.
all right. How's everybody doing today? Well, I guess nobody can speak back, can they? It's a one-way conversation for the moment.
Right.
Well, I'll start everybody out as people are joining in. This is our first webinar with the USMCA, and we're really excited about it. First off, I wanted to welcome the board members that have made themselves available to attend this afternoon/evening. So we have Christy LaCurl, we have John Eric Burleson, we have Paul Puma, we have Jeff Emig, and then we have Nate Ramsey, and they are with Mark and I this afternoon, evening, and then our guest panelist today. I'm gonna let Jeff Emig do the honors, and he will introduce our guest speaker this afternoon.
All right. So everybody, welcome. I'd like to thank everybody for being a USMCA certified coach, and I'm sure I don't have to explain it to any of you how important. Hold on, I think I just lost something here. My apologies. Can everybody still hear me or no?
Yep.
Okay. Well, I can't see anybody now. The page went away. Anyway, you know, coaching is, as you guys know, super important. And whether it's for something financial, whether it's you're learning a new sport, you're training, really the best way to not just shortcut the process, but to make sure that you are on the proper track is, as far as your learning, is to hire a coach. I mean, my son Jagger plays soccer at a pretty high level. We're constantly looking for better coaching, higher coaching, things like that. And even as much as he, here in this last month or so, has told me that he wanted to learn how to play golf and he wants to learn how to surf. And even though I do both of those sports, I wouldn't begin to, think that I could coach him from the beginning, because I know that if he gets the proper coaching from the beginning, that his foundation in learning the sport will be much better. Anybody that's surfed with me or played golf with me, you know what I'm talking about. So anyway, back to the USMCA stuff. You know, we are making progress as a coaching association, and we have over 400 coaches right now. So we're really, really excited about that. That's when it really starts to scale, because each coach has, you know, anywhere from 5 to 50 or more riders that they coach. So the numbers really grow that way. And we'd like to thank all the coaches for their continued dedication to remaining USMCA certified and giving us a qualified network of coaches to promote our industry, build the sport, remember? So our partners recognize the importance of this, and we are grateful for the strong partnerships that we have. We aim to use those partnerships to create value for the certified coaches. And today we are happy to host our very first webinar with the support of our longtime partner, Wells Fargo. They have been kind enough to present their economic outlook to our board, and we feel that it is valuable information to our coaches. So I would like to introduce Jackie Benson, VP of Economics at Wells Fargo. Take it away, Jackie.
Thanks. So my role at Wells Fargo, I work with a team of economists, and we basically spend all day not out in the beautiful world riding bikes. My husband would be doing that. He's a tech, so he gets to work on bikes and cars all day. No, we spend the day in the data, figuring out what's going on. And then it's my job, along with my team members, to go out and explain it to everyone else. So that's what I'm going to try to do here today. We'll see if I can share my PowerPoint that I have in just 1 second.
Also, I did want to just make one note, for any of the coaches that are on this afternoon, you are, if you have a question at all during Jackie's presentation, you can either raise your hand or you can type it in the Q&A box on the bottom. So I know you guys can't speak. So if you have a question or something during her presentation, just use one of the Q&As or the raising hand.
So should I be looking out for that?
Yes, and Mark will help you with that also.
Okay.
Yeah.
Yeah, I'm more than happy to answer questions during the presentation. I just won't be able to see anyone while I'm actually presenting. So, I mean, need some help.
Yep. Mark can help you.
Okay, great. There we go. All right. So, yeah, like I said, I'm here to talk a little bit about our view of the economic outlook. So what we're looking at here is our forecast. This is showing growth rate in real gross domestic product. That's how us economists measure the economy. It's basically the sum of all goods and services produced domestically, doesn't include anything produced overseas. And then we see how fast that quantity grows over time. The reason why it's real GDP is because we adjust it for inflation. So instead of capturing volatile price movements that can inflate the value of this sum, instead it just gets at the quantity of goods and services produced. So the red bars at the end here, that's our forecast. And we are currently forecasting a recession. That's what these three negative red bars are. So the reason why we're not in a recession right now is because the data has been very strong to start the year. We've had impressive job gains, over 500,000 jobs created in January, and then another 300,000 in February. Consumers have been spending at a very strong pace in the midst of high inflation and rising interest rates. Consumers have proven to be very resilient. But there is weakness starting to manifest in the manufacturing sector. And moving forward, we do think that the recent turmoil in the financial sector is going to have an impact. So in case you don't know, recently there's been several regional banks that have failed. They've basically collapsed under the weight of rising interest rates as the Fed has embarked on bringing down inflation, right? And the way the Federal Reserve brings down inflation is by increasing interest rates and tamping down on the economy, basically trying to slow economic activity enough that it stops prices from rising so quickly. Well, the Fed rose interest rates and eventually something broke. So we saw 3 smaller banks fail and have to be bailed out. Moving forward, we do think that that's going to result in a myriad of things. A, probably more regulation put on banks by the government. B, probably stricter lending standards that the banks are going to enforce on businesses trying to borrow from them. So there's going to be less liquidity, less credit available for businesses to borrow in order to grow and to hire, invest. And all of that is going to tip the economy into recession in our view. Now, it's important to put our expectations into context. So we do expect the economy to move into recession kind of toward the middle of this year, the second half. However, we don't think the recession will be especially severe. So we are looking for a decline in real GDP from the peak to the trough, from the high point to the low point of about 1.2%. That's nothing compared to what happened during the COVID recession. And then GDP declined by nearly 10%. And it's also not nearly as severe as the Great Recession, when the economy contracted by 4%. So it's our forecast suggests a pretty mild recession. This chart on the right also shows we are expecting the unemployment rate to go up, along with, businesses not being able to hire, not having enough money, and having to let people go. But we don't expect the unemployment rate to rise by nearly as much as it has in recessions in recent memory. So what's driving our outlook? This chart here is super fun, in my opinion. I know it's kind of hard to understand. Basically, what we're looking at is inflation. I'm sure everyone here knows that inflation has been a big struggle pretty much since mid-2021. What we're looking at here is one measure of inflation called the Consumer Price Index. This is a figure produced by the government, and it basically tracks the prices of what we call a basket of goods. So it's a representative sample of goods and services that an average household might purchase, might consume. A few things to note in this chart. First is before 2020, inflation was very steady, hovering around 2%. After 2020, you saw this huge explosion of prices across all the categories of goods and services, and it reached 9% at one point in the middle of 2022. That's very abnormal for the United States, and it was in fact, and still is, the highest inflation rate since the 1980s. Moving forward, we do think inflation will continue to come down. The most recent measure has showed it falling from that 9% figure it topped out at to about 6% based on this measure. And we do expect that to continue, mainly because goods prices have been falling as supply chains have kind of come back to normal a little bit. And also energy prices have stopped increasing so rapidly and have even fallen a little bit, depending on what you look at. But the descent in inflation is proving to be quite slow, quite sticky. It's not coming down in any sort of rapid pace. So we do think inflation is going to remain elevated over the next couple of years, above that 2% that is normal for the US, and that the government targets, the Federal Reserve, who's in charge of basically keeping inflation in check for the United States. They look for a 2% number. And right now we're at 6%, so nowhere near close. So this is another look at inflation. Basically, us economists, we tend to focus on what we call core inflation. So that strips away volatile prices in food and energy, not because food prices and energy prices are unimportant. In fact, they're some of the most burdensome prices that families have faced over the past couple of years. The reason why we look at core is because food and energy prices are really set on global markets, and so US policy doesn't have much control over them. So if you look at that core goods in the red line, you can see that it really spiked, and that was in tandem with the supply chain crisis, when we had 100 ships waiting off the coast of California to offload goods that consumers were buying while we were all stuck at home, and we couldn't go out to the movies, and we couldn't go out to eat at restaurants. So we just turned to online shopping, e-commerce. We imported a ton of stuff that our dock workers and our truck drivers just didn't have the capacity to handle. So that really shot up prices. Recently, though, you can see that inflation has turned around quite dramatically. And goods prices on an absolute basis have actually been falling over the past few months. Now, the blue line is what's more concerning, and that's services prices. So you can think of things like medical care services or entertainment, airfare. When my husband works on people's cars, that automotive service, that is included in here. And those prices have been much more stubborn. They haven't come down nearly at all. The reason being that labor costs are propping up services inflation. So let me explain that real quick. In this country, we have more demand for labor than there is workers available to meet businesses' needs. So that's causing, these labor shortages are causing businesses to have to raise wages at a rate that's quite historically high. And that wage pressure is also putting pressure on prices, causing businesses to have to raise their prices to be able to cover their labor costs. As long as services inflation continues at this rapid pace, and there's really no indication that it's softening, inflation is going to be a problem for the country in the United States. So this chart is specifically looking at vehicles. We have new vehicles, which motorcycles are included in that category in the blue line, or I'm sorry, in the red line. And then we have sports vehicles, which includes like ATVs or bicycles, just to show a different flavor. The reason why I wanted to include this chart is because, you know, I said that goods prices are falling. That's true for some goods. It's not true for all goods. And also, even though goods inflation is falling, so the rate of price increases is not quite as quick today as it was, you know, a few months ago or in the middle of 2022. Just because that inflation rate is lower doesn't mean for all goods that the price is lower. So you can see here that the prices of new vehicles and recreational vehicles and bicycles remain elevated well above what was considered normal before 2020. So as you can see, inflation remains an issue. And like I said, the Federal Reserve is tasked with bringing inflation down. Their main tool to do that is something called the federal funds rate. This is one interest rate that influences all others in the economy. And the Fed has been raising this rate for a year straight. We've gone from basically being at 0% last March to now they just raised it to 5%. So that's a very rapid pace of interest rate hikes that we've undergone over the past year. The red line again here is our forecast, and we are expecting the Fed to raise this rate one more time, but we do think that they're close to being done. So we think they're only going to raise it one more time and then hold the interest rate there at 5.25% through the end of the year. And then as we enter a recession kind of toward the second half of this year, we do think the Federal Reserve is going to be motivated to cut interest rates. So if you cut interest rates, and it helps the economy because it makes the price of borrowing cheaper and it stimulates economic activity. And that's generally what the Fed does when we are in a recession to try to boost economic growth and help get us out of it. So we do expect the Fed to start cutting rates, with the first cut being at the very end of this year and then through next year at a pretty rapid pace until we get back down to something in the realm of a normal interest rate at about 2.5%. So this chart just really quickly wanted to throw in to show you how fast the Fed has been raising rates this time around. We are the red line in the middle, and it's the fastest pace of rate hikes since 1982. Back then, we were in what was called the Great Inflation, and then chair of the Federal Reserve basically had to put his hands around the neck of the economy, bring us to the brink of near collapse in order to bring inflation down. So we're in pretty historical territory right now. There's been many results of the Fed's interest rate hikes, something called monetary tightening. One very clear result, and the way that it translates easiest into the economy is through mortgage rates. So this shows that mortgage payments have really been a burden on households. Mortgage rates went from being somewhere in the realm of 3.3% in December 2021 to, I think the last I checked, they were at 6.4% now, but they reached as high as 7%. And as someone who, I'm not a homeowner yet, I'm still renting, it's kind of daunting, right? And it's really caused the housing market to kind of enter into this correction, and it's been a real burden on families. So the other thing that we expect, like I talked about a little bit, is for lending standards to tighten. So this chart on the left here shows the percentage of banks that have already tightened lending standards, which basically means it's just harder to get a loan. And even before we've had these banks fail, the Fed's monetary tightening and fight against interest rates was causing banks to crack down on their own lending. So we already saw this uptick in the number of banks making it harder to get a loan, which, if you look at the chart on the right, had a direct result on demand. There was less firms applying for loans as a direct consequence of those tighter lending standards. So both of these charts are backward looking. The latest data it shows is the end of last year. We expect this situation to exacerbate quite rapidly, and for the banking crisis to result in a big instability in financial markets, and also just reduce the total amount of money available in the economy for businesses to use. So we do think that the recession is going to start on the business side based on this lack of available funding. So as businesses get squeezed, we do think that they're going to have to let go of workers. So if you look at the red bars here, that's our forecast, and the negative bars represent job declines. If you add up all of those negative bars, we're looking at about 1.3-ish million jobs lost. And that is a big number. It seems like a lot, and it is a lot. But if you put it in the context of what's happened in like a normal recession, prior recessions, it's pretty consistent with our expectation for a mild recession this go round. So at the same time, we're not expecting mass layoffs attuned to the Great Recession, right? And the reason why is because we have such a tight labor market. What that means is that there's not enough workers to fill the open jobs. So businesses are going to be hesitant to let go of their workforces, not knowing if they'll be able to find someone, you know, once things turn around, to fill that position. This chart just shows that there's 2 unemployed people for every 1 job opening in the US, which is a severe labor market imbalance that's really keeping the pressure on businesses to hang on to their workforces as long as they physically can. So the flip side of those job losses I talked about is the unemployment rate. We are expecting the unemployment rate to tick up, and we're looking for it to top out at about 5.2%. Now, that's not even half of what happened during the Great Recession. So although that is an increase, it's very mild in the context of other recessions. So the million-dollar question: how are consumers going to fare through all of this? This chart is one of my favorites. And yes, I am a total nerd. But basically what we're looking at here is spending. So we're looking at real spending, inflation-adjusted spending, which gets at the quantity of goods and services that people are buying, right? And this is all relative to February 2020. That's the month before the world changed because of the pandemic. There's a few stories to tell in this chart. The first is you see this huge shift where consumers really shifted their consumption toward goods, and durable goods especially. You know, a lot of that was because we were physically limited in what we could buy. We couldn't buy services. I couldn't go get my nails done. We couldn't go out to eat. So consumers just shifted toward goods. But durable goods specifically, that was really afforded by the ultra low interest rates throughout all of 2020 and 2021. You know, the Fed didn't start raising interest rates until March of 2022. So for all of that time, we were at 0% interest pretty much. And that really allowed consumers to buy cars, motorcycles, those durable goods with low financing costs that we were able to buy during COVID. The purple line services, you can see that took quite a longer amount of time to recover to its pre-pandemic normal. So something to note here really quick, inflation started picking up in the middle of 2021. And then the Fed started raising interest rates, like I said, in March 2022. I would think that people would respond to high prices and to raising interest rates on their credit cards and pull back on spending. But I don't see any of that here. Basically, consumers showed incredible resilience in the face of both of those challenges, high inflation and rising financing costs. That really surprised all of us who were paying attention. So this shows motorcycle sales. This is based on Department of Transportation data. The latest we could get is 2021, so it's a little out of date. But what I want you to focus on is at the very tail end here, we have an 18% increase in motorcycle sales from pre-pandemic in 2019 to 2021. Now, that's very consistent with the general consumption patterns that we saw that I just took you through about that shift toward durable goods and how consumers really picked up their spending during the pandemic. Now, the $1 trillion question: how in the world were consumers able to afford this? It's a multi-part answer, and so this is the first part of the answer. What we're looking at here is something called excess savings. So normally there's some level of savings in the economy. And how we measure this is every month, it's economy-wide income, how much people make, minus economy-wide spending, how much they spend. So the result, if you do that, is economy-wide savings. During COVID, we had the government respond with its response legislation, the American Rescue Plan. And that was a $2 trillion cash transfer, pretty much, from the government into households. The thing is, people didn't spend it. They either couldn't spend it because our spending was still constrained because of the pandemic, or they didn't have the need to spend it. So it amounted to pretty much $2 trillion of excess savings in the economy. Now, moving past that legislation, this accumulation of cash did help consumers spend at the pace that they did. It helped to fuel that big increase in spending on durable goods and on other things at the pace that they might not have otherwise been able to do. So you can see that these excess savings have really dwindled over time, and now we're at under $1 trillion. There's still enough savings, just pure savings, left to fuel the current pace of spending through the end of the year. But consumers don't actually need to rely on this as much anymore. And also, this pile of cash isn't going to last forever. So this is another way of looking at, how were consumers able to spend at such a rapid pace. What we're looking at here is the savings rate. So it's saving as a percentage of income. You can see very clearly 3 spikes that occurred during 2020 and 2021. These exactly correspond to the 3 rounds of stimulus payments, direct payments to households that, like I said, we either couldn't spend or didn't need to. And this accumulation of these 3 spikes helped to fuel the downward fall in the savings rate. And toward the end of last year, the savings rate actually reached a near historic low. It was one of only a handful of times that savings dipped below 2.8%. Now, more recently, the savings rate has started to go up, and that's mainly due to incomes performing better as inflation has eased. So this is showing that story. We've had inflation come down a little bit, and also we still have an incredibly tight jobs market. Employers are having to raise wages to attract workers, so incomes are in a much better place today than they were 6 months ago. That's allowed inflation-adjusted incomes to rise for about 7 or 8 months after they fell month over month for a year and a half. Now, moving forward, this increasing income situation, increasing financial health is going to be a more sustainable source of spending power for consumers. That said, we do forecast that personal spending is going to outright decline. This is consistent with our recession call, and peak to trough, similar to the entire size of the economy, we're looking at just over 1% decline in economy-wide spending. The reason why we think spending is going to fall, even though we expect incomes to be in a good position, is because of our forecast of layoffs. As people do engage in layoffs, they're not going to be in a position to spend as strongly as they have been. The same idea is with the tighter credit conditions. So we've already seen consumers respond to the raising interest rates on their credit cards, pulling back credit spending a little bit. And that's just going to continue as the Fed continues to raise rates, and also as lending conditions tighten moving forward. So while we do expect spending to contract, it won't contract for very long in our view. We have it growing again starting in the second quarter of 2024. So that's it for me. I'm happy to answer any questions. And if not, I hope that was helpful.
Thanks, Jackie. That was super interesting. And you know what? I kind of think I might be also an economics geek because I was riveted by a lot of the data. It's actually staggering when you look at some of the numbers. So before we ask overall for questions, and I'm looking at if any hands are raised here, I would only just add a little bit of context to what we heard was, yep, expecting a recession back half of this year. Sounds like the valley might be relatively modest and short, which is pretty interesting. It's also super interesting to see consumer spending and the opportunity to spend and the transition from goods purchases to service purchases, because as a coaching association, obviously we provide more of a service, and there's a lot of motorcycles in the marketplace. There's a lot of motorcycles on dealer floors, and the service that we have to offer is probably never been more valuable for the coaches on the call. This is in a way an opportunity for us to really become an even greater opportunity for supporting the industry. There were a lot of new riders that entered during the COVID uplift, as we saw from the new unit increases, and I know overall ridership was up. With coaching, we offer not only the opportunity to have a great first experience, but I also think about it as a retention tool. If you think about riders that are being coached or at the track, even if it's once a month or even once a quarter, the more often that they're riding, the more engaged they are in the space, and the better that is for the overall motorcycle industry. And for the coaches on the call, I think this represents, also there's a lot of motorcyclists out there that probably bought units and are looking to spend more money on experiential things like getting a great coach. So in a way, I actually see this as a very positive set of data. I don't love recessions, to be honest, Jackie. So we're going to, not beat that up too much, but on the same token, for every down cycle, there's always somebody that wins. And I think the coaches on the call, the opportunity for us is to win and become even more a viable solution for the industry to keep not only the riders in, but also growing the sport. Last comment I would make would be, we have worked really hard as a team. Mark and Lindsay just continue to push our app, motorcyclecoaching.org, and our motorcycle coaching app. And one of the challenges we've had over the past, let's call it year, other than the technical challenges that developing your own app comes with, is coach availability. So I would encourage everybody, if you have availability, please make sure you're using the app. We want to show the industry that we have a robust network of coaches, and ultimately that we're there to connect the riders that are looking for a coach to the coaches that are available and taking on new clients. So with that, I may say now it is time for the Q&A, unless any of my other fellow panelists want to add any context to my comments.
Actually, we did have a couple questions come in. John Eric. First one from Jim Duggar. Do we have a sense for the demographic distribution of savings rate and spending power? Our sport can lean a bit to the more well-off on the sport bike side, and it would be interesting to know if your opinion is to expect some demand resilience, somewhat like luxury goods have enjoyed.
You know, I might make a comment and then ask Jackie if she has any. One thing that we've really seen, at least from my time at the OE table, is one of the most correlated things is housing. And if housing is robust, which I noticed there was no decline planned in housing prices, it looks like it moderates in the overall inflation metrics. If houses are being built, that industry has such a long tentacle to and a high correlation to our motorcycle consumer that I think there will be some resiliency, so long as, all the way back to what Jackie said, if people have jobs. That said, I don't know if there is a demographic distribution that you guys at Wells Fargo studied.
Yeah, so good news and bad news. Good news, yes, services consumption is the faster growing consumption category right now. We have seen this shift back from goods towards services. You know, goods consumption is still high relative to what it was before the pandemic, but there's definitely this re-entering of the world that consumers are longing for, and that's clear as day in the data. So I would expect, even during recessions, you know, and not every recession has services spending fallen, actually. So in this recession specifically, because we are expecting the financing costs to kind of squeeze businesses, and because manufacturers are generally bigger or more reliant on those capital expenditures, we expect manufacturing to kind of be hit first, but services could very well end up staying the course and being resilient. So that's good news. In terms of the makeup of those excess savings, there has been some studies done at some regional feds, and they found that a lot of the excess savings that are left are concentrated among wealthier households. So it is very true that wealthier households can absorb the downturn better. So you could see that spending resilience keep up among the wealthier side of the economy, whereas the more lower income folks might pull back first. And then on housing. So the bad news is that home prices are falling. I didn't cover it in my presentation, but based on median single family homes, they've come down about 3 to 4% from their peak already. The reason why is because mortgage rates. People are not willing to, you know, take on a 7% mortgage rate, a 6.5% mortgage rate. And the people who currently own their homes are also not willing to sell their home and trade up to a higher mortgage rate. So what that's doing is keeping home prices from falling too much, because it's keeping the supply of homes smaller. It's complicated, but the main story of what is happening in the housing market is that it is showing weakness because of the Fed, but nowhere near the weakness that we saw during the Great Recession, during the housing bubble. So we do expect home prices to fall a little bit more, but not nearly the 25% that happened in 08, 09.
Hey, I see we also have another question from Joe about advising if they should increase coaching rates, so labor rates. I would, comment on two things. One, by the way, thank you, Jackie. That was way better response than mine. You have to think about your service rate, I think, in two different ways. What's the competitive market? So think of it like a labor rate at a dealership. If you're in a high cost area and you are forced to have a higher labor rate and everyone else is having a higher labor rate, then you're going to have an opportunity to maintain a higher rate when everybody else around you is that higher labor rate. And I think that's market to market, and it depends on everybody's costs. The second piece of it would be just the general term price elasticity. If you are turning customers away or clients away and struggling to pay your bills, it might be worth looking at raising your rate a little bit. Generally speaking, there's a point there that as you raise your rate, whether it's hourly or I know a lot of coaches do like 4-hour blocks or half-day blocks, that kind of stuff. As you raise that rate, if you start having more clients going away than you have coming, then you might have gone a little too high. So to me, it's a combination of what's the local market and what is, the elasticity of your clients, if you're fully busy or you're searching for clients. I don't know, to any of our coaches, either Nate or Jeff, if you guys are hearing something different in the marketplace that you want to comment to.
Yeah, for me, I think you nailed it. I really don't. I see this as a small recession happens, people are not making the big purchases, so potentially they'll go, all right, well, let's get some coaching, and ultimately can spend the money on that side of things. So I honestly haven't seen or heard of anything changing much along those lines. And I think as far as coaching goes, like, I think the world looks at coaching quite different these days. Like you said, or Jeff said in the beginning, people are basically looking for coaches in every aspect, whether it's running or, football, baseball, mainstream stuff. And obviously to us, motorcycle racing is one of the most important and one of the most beneficial ways to get coaching in a lot of ways. So I think that the more we get the message out there, the less any of this is going to affect us, and the more availability that we have with coaches being very responsive and receptive, and creating this safe environment to retain these people who are maybe first time or kind of step back through their leg back over a motorcycle. I think that's where we will definitely benefit and boost our whole industry, which ultimately circles back around to the coaches, whether you're coaching early riders, beginners, or all the way up to the top.
The one thing I would add, thanks Nate, that's good, is I would add also that I've heard the comment that many dealers have been focused on just scramble for 2 years during COVID to get units and do the operations and deal with all of the challenges there, that in some cases we have to get back to doing the good old-fashioned sales job. And I think as coaches, you guys are really in a unique position. You've probably always been in the good old-fashioned sales position, and what the grind is like. Just remembering that, and making sure that, to Nate's point, your responsiveness is good, and making sure that the outreach is good and the connections are good. The experience is great, of course. I think some of the things where we used to have riders knocking on every door, we may have to just be a little more responsive to keep that activity coming alive. And that doesn't directly relate back to rate, but if you're a great coach that has a great experience and you're in a field of coaches that are doing something less than you're doing, you also have the opportunity to maybe charge a little bit more than your competitors. Any other questions? I think we answered 2.
Yep, Scott Miller just put one in. Great presentation. And I'm sorry, Jackie, I did miss that Jim also mentioned fantastic information. So everybody's thankful for you being here. Scott's question makes sense. Can you talk a little more about the growth in services, the outlook on it?
Yeah. So like I said, we are currently forecasting total spending to fall. So that includes goods and services. First, we think, and our estimates suggest that durable goods spending is going to fall. That's largely because of those rising interest rates I talked about. most credit cards are variable rate. So as the feds raised rates, you saw credit card interest rates go up as well. So we do really think it's going to hit the goods market harder and first. That said, once layoffs materialize, and if job growth slows, as we also estimate, then that too will have knock-on effects and hit the services sector as well. However, not as much in our view. So services are generally more resilient during recessions as opposed to goods. There's a lot of reasons for that. So with goods, it's globally traded as well. So usually if the US falls into a recession, we're not the only country, and we're also not the only country that we forecast going into a recession. However, with services, it's a little bit different. So that's a long way to say we do expect services spending to fall, but not by very much. And like I said, kind of echoing throughout this entire presentation, the main takeaway is that I view this more as a correction, right? So we had 2020, 2021, we had the Federal Reserve pump a ton of money into the economy. We had Congress pass COVID responses that similarly were cash transfers and help people get through COVID, but all of that kind of created this bubble. And now we have to come back down to earth. And that's, in my view, what this mild downturn is. It's just us correcting ourselves and getting us on that pre-COVID growth path. So the words to remember are mild and short-lived.
Thanks, Jackie. Any other questions from the group? Looks like we answered all three, and it's nice to see Scott Miller on the call, by the way. Thanks for joining us. I would say that was really good feedback. Mild and short. That's, if you're going to have the word recession, those are two great words to bookend either end of it. So that's awesome. And, I would come back to what I said also just a little bit to remind ourselves, gosh, during COVID, there was probably so many people riding and so many things doing that it was easy to stay focused on just doing what we do and focusing on our product. And we're probably going to have to get a little bit back into the sales side of things and selling, our services and really being quick with our follow-up. And I really encourage everybody to make sure they're doing their profiles up to date, and they're utilizing as much as they can their motorcycle coaching app. And with that, I want to say a special thanks to Jackie and Paul from Wells Fargo. Awesome to have you guys join. I know a lot of our group may not get a lot of access to this kind of a presentation, and it's nice to give us a sense of what you guys, with all of your information and data, think the market's going to look like. And so thank you very much. And with that, any other sign off from any of the other board members? Thank you from my side for everybody who attended.
Yeah, just, I've seen this presentation a couple times, and I think what really sticks in my mind, especially as far as these interest rates and of the buying of the new goods that you might need a loan for, things like that, seems like it's slowed, but the overall number of units that we have, since COVID started to now is high. So these individuals, they have their motorcycle. Okay, so maybe they're not buying new ones, but they have these motorcycles. Let's do everything we can as a group and as an industry to get them out on two wheels, get them riding, whether it's on the track or on the motocross track, and using the motorcycle that they already have, so that we create the lifelong motorcycle. And that's all I have.
Thanks, guys. Appreciate the feedback and appreciate everybody joining.
Thank you. Thank you, Jackie. Really good job as usual. Appreciate it.
Yes, thank you. Thank you.
Yep. Thanks, everybody.
Cheers.
Yeah, thank you everyone for tuning in.
Bye.